We're often told that financial markets are forward-looking devices. They try to project forward months in advance as to what is going to happen. So it's not necessarily the prices today that are being dictated by news today. But I think the environment we're in at the moment is so uncertain that markets are having to concentrate on the here and now more and more in trying to establish how this market is or economy is going to recover. And it's hard to gauge exactly what the market is looking for. I think the big push-pull at the moment that is taking place is that every time we're getting positive economic signals, markets worry. They worry that this means that central bankers are going to start to take their foot off the gas and start to withdraw from some of this accommodative easing that has been taking place. So this week, for example, in the UK, we've had some quite positive news on the economy. This sort of countered the rather negative OECD report that indicated that the UK may have gone back into a technical recession by reporting a negative first quarter. Ever since that report came out, we've had PMI data, we've had other sector-led data, retail sales numbers that are all indicative of an economy that may well have grown in the first quarter. So I say we have positive news there. In America, again, we had last week news from Ben Bernanke, which the market interpreted very much as accommodative, that he would continue easing on the monetary policy. He was unsure about the recent jobs data that was coming out was sustainable, and that he would keep his foot on the gas. This week again, he's been out speaking, and this time the market's taken a different view. So as I say, it's very hard to get the reading of markets as to what they want and how they want it to deliver. And what that is leading to, I'm afraid, is quite a bit more volatility. Now, in last week's podcast, I did highlight the VIX chart, which I'd indicated that there was a chance that in the next quarter that the volatility of assets would begin to rise. And this week, we've very much got back into that frame. Equity prices have moved quite significantly to the downside, and volatility is again on the rise. So let's just take a look at some of the charts that are moving at the moment. This, starting off with the FTSE 100, shows this sort of very sharp decline that we've seen here in the in markets this week. I suppose one comment is that we saw just last week a sort of sharp fall with a very quick rally back up into the sort of area. The speed that it's been sold back into is not a good sign, but it means that as we currently speak, and this is ahead of the interest rate decision in the UK, that markets are back down towards the low end of the range. Now, the key to why this is happening, well, first of all, I think we're going to turn to China for what's been taking place over there. If I can pull up a chart of the Australian dollar. An interesting number that came out this week, which didn't create too much attention, but I think is worth commenting upon, is the trade deficit. Now, Australia is a large landmass with huge amounts of resource. It doesn't have many people, so its import demand relative to what it's able to export, it tends to run consistently large trade surpluses. And indeed, during the course of this February, they were expected to generate over $1 billion of surplus, but the number came in with a negative number. It was down $480 million. Now, I can't believe that's as a result of a surge of import demand for Australia. What I can believe is that exports, which are mainly going into Asia, mainly going into China, of commodities and resources, were probably markedly lower than anticipated. Now, again, last week we commented upon the fact that markets have been pricing in a slowdown in China, but possibly now for 2 or 3 months. But I think even despite that, that Australian number was quite alarming and indicative possibly of a slower performance in China than anticipated. Again, we always get contradictory data. Sunday evening we had the China PMI data, which came in better than anticipated, and that did initially give the markets a little bit of heart earlier in this week. But we've got to look at surveys and what people feel about life relative to the real numbers, which is obviously trade deficits. And at the moment, I'm afraid the market has taken the view of the hard numbers are telling the more likely story. If we now take a look back into Europe, again, Spain has been a constant thorn in the side for markets this week. The finance minister was out delivering the budget this week. He's talking about 16% budget cuts into many of the public sectors in Spain. It sounds a big number. I'm reminded that George Osborne was talking about 19% budget cuts in the UK back in 2010. So it's really consistent with what the UK's austerity drive has been about over the last couple of years. But the concern over Spain is that they just don't believe the numbers. They're being tasked with delivering just a 3% budget deficit for next year, and that looks a huge task relative to the position they're in today. And as a result of that, we've seen bond yields in Spain continuing to rise. We did have a bond auction this week that went poorly, and particularly it went poorly in areas where the LTRO programme was unable to assist. And I think it just sort of reconfirms that view in the market that the LTRO programme is buying some short-term relief, particularly to short-dated paper, but when these countries are trying to build out the maturity of their debt profile, it's finding it very difficult without LTRO aid. And as a result of that, we are seeing now yields beginning to rise in Spain. It is also having a negative impact on the stock market in Spain. This is a one-year performance now, and you can see how really poorly it's performing, and particularly so relative to other European markets in the course of the last quarter. We've seen some quite dramatic rises, such as Germany that has performed very well, and America that's performed very well, but Spain is now posting double-digit losses in the first quarter of this year. Turning closer to home, a couple of stocks that we're commenting upon this week at Killik & Co. The first is Weir Group, which we think has been unfairly treated in the course of the last quarter. Shares coming down from £22 to £17. There have been some bear stories about the whole oil services sector. This is a company that is in the FTSE 100. It's a big business, and therefore one of the worst performers this year. But we think that the bear story has been overdone, and that we're now back at a level which offers intriguing value. The bear stories have been created on the back of US competitors that have been reporting fairly mixed signals at the moment, but we believe that the appropriate signals to read across are more positive, and therefore the market may have become a little bit too bearish about Weir in the short term. So we've put a note out on Weir. So equities have had a poor week. They're back down towards the low end of the trading range, and nerves are beginning to jangle. But if one can look towards positive signals that could be forthcoming in the near term, I'm turning to the US corporate reporting season. The end of the quarter, March 31st, means that during the course of mid-April we'll have the S&P 500 companies reporting earnings, and one hopes to see not only positive momentum from earnings from these businesses, but also upbeat comments from CEOs, and hopefully that will put a bit of lift back into equities just when they need them.